Hello everyone, my name is Rohit Sharma and today let us discuss about the mutual fund investments. So you would have heard that mutual funds sahi hai and you would have seen a lot of advertisement campaigns regarding the investments in about the investments in mutual funds. So today we will discuss about what factors to look into while you are planning to invest your hard-earned money in mutual funds. Basically, one should firstly look into their own investment horizon and the amount which they are planning to invest. So everybody invests according to their own goals and according to their own wealth requirements at their various stages of life. So for example, if you are a beginner, like if you are a millennial just who has started their career and who wants to build a good sum of wealth over a long period of time, so you should start with an SIP. What is an SIP? An SIP is basically a recurring monthly deposit into any fund of your own choice. So the fund which we will discuss about is, for example, a large cap fund or a small cap fund or a mid cap fund. What are these? Basically, these are all types of mutual funds. In these funds, basically what happens is people pool in their funds and pool in their hard earned money, and then some professional fund manager manages that money efficiently enough to generate a good investment return. How does he manage that money? What he does is he takes money from the public and then invests it into various arenas. That those arenas may be stock markets, those arenas may be bonds, those arenas may be alternative investment funds, or even it may be other funds. There are mutual funds who invest in other mutual funds. So that is also another concept basically. So first of all, you have to select your investment horizon. Investment horizon may be 5 years, 10 years, 15 years, 20 years. Anything above 10 to 15 years is called a long term investment horizon, and anything below 5 years is considered as a short term investment horizon. And this is considered in common parlance. Basically, it is not, as per a rule book, it is not written anywhere that below 5 years is short term, but as a common understanding in the investment world, an investment less than 5 years is considered to be a short term investment. So accordingly, you have to choose which funds to invest in the short term. So in the short term, basically, mid caps and small caps funds have been seen to outperform the large cap funds. But in the longer duration of over 10 to 15 years, large capital funds have outperformed the returns of mid cap funds. And what are large cap, mid cap, and small cap funds? Let's come to that. I'll just give you a brief knowledge about what these are. Capitalization basically is the value of a company in terms of their number of shares and the price of that share. So a fund which invests in large cap segment basically invests in the leadership companies of those segment, and a fund which invests in mid cap segment invests in companies who are of a mediocre size, and the smaller ones basically are the small cap investment portfolios. So you should have an investment horizon number one, and in that investment horizon you will select which category of funds you should invest in. The next thing which you should see basically is the expense ratio charged by these fund managers. What is an expense ratio? An expense ratio is an amount which is deducted from your investment as a fee for managing that fund, right? So if it is a multi-cap fund, which means that the fund manager has his own choice of managing the funds, like he can judge better which capitalization funds will perform well. He will put his money in that fund at that point of time. So it is based on his own judgment and choice. So that is why the expense ratio is higher, because he demands a higher fees for working extra. And consider, if it is a large cap fund or it is a specific cap based fund, the expense ratios are lower because the direction is fixed for the investment arenas. Apart from that, what we need to understand is the assets under management available in that particular fund. For example, the main cause of looking into the assets under management is that if the fund size is large enough, for example, if the fund size is above 10,000 crores or 15,000 crores, then there is sufficient liquidity available in that fund to give you the money back in case you need. So there are two types of mutual funds: open-ended and closed-ended. The open-ended funds are like you can withdraw your investment whenever you want, and the closed-ended ones mature on a specific date, and you can only withdraw after that specific date. You cannot withdraw your funds before that. So in case of open-ended funds, you have to be aware of the assets under management, which is the amount of funds being managed by that fund manager or by that mutual fund specifically. If the amount is high enough, then you can stay assured that the liquidity is good, and in case you require your funds back in times of your need, you can get back the money easily and smoothly. If the fund asset management is small, then obviously if too many investors rush into withdraw their funds, then the fund may have a scarcity and may delay your payments on withdrawals. So there is a risk involved in that. So these two things which we mentioned are the basic criteria to look into. Apart from that, you can also look into the performance of the fund manager himself. You have to see the experience and the quality which is maintained by that fund manager in managing the assets, and his background needs to be checked, like the number of funds which he has managed in his career and the returns which he has generated for the investors over the past 15-10 years, if he has an history of 10-15 years, of course. And apart from that, you can also look into various other criteria which include, like, for example, if you say you can look into the risk profile of your own self, whether or not you are able to invest in high risk assets or not. Because if you are, say for example, a young guy, you can obviously choose to invest in a higher riskier class of asset. A higher riskier class of asset basically involves higher investments in mid cap and small cap funds and in the equity funds. So there are equity and debt related funds also, and in the debt funds the return is lower and the risk is also lower, and in the equity funds the returns are higher and the risk is higher. And even in the equity, you can subdivide it to large cap, small cap, and mid cap equity. So the large cap equity is comparatively safer, but it gives a lower amount of returns, while the mid cap and small cap equity give a higher amount of return with a higher risk. So if you are a young guy, you can allocate more of your funds in the mid cap and small cap segment and balance it out with a smaller portion of investment in, say, bond or debt mutual funds. So in that way you will build a better portfolio. And you should also look into another aspect, whether or not you are investing in a growth oriented mutual fund or a dividend option mutual fund. So what is a growth oriented and a dividend option fund? Growth oriented is, for example, if you are earning dividends, whatever dividends you are earning out of a mutual fund, those are reinvested back into that fund and you get additional units. Whenever a dividend is declared by the mutual fund industry, you don't get it in your bank account. It is reinvested in that respective fund only and you get additional units. So in the long run, your number of units are higher and then you earn a higher income. But in the dividend option, you get frequent dividends cashed out into your bank account. So if you are in need of recurring monthly payments, or I'm sorry, not monthly, recurring quarterly or yearly payments, as and when it is declared by the mutual fund company, you can opt for the dividend option. But if you don't need those funds at the immediate moment, you can choose the growth option. In the growth option, you will get additional units of that same mutual fund and your money will constantly keep growing at the same rate, and also you will get the compounding benefit. So these two differences also you need to look as per your investment horizon. What we generally personally suggest is to opt for the growth option mutual fund for if your duration is longer and if your investment amount is a low amount. If you're starting with a low budget investment, then you should prefer the growth option, because say if you get a very small amount of dividend every year or every month and you don't have any use of that fund, then it will go to waste. Rather than if it is invested back to the fund, it will keep growing along with the existing investment amount. Apart from that, you should also look into what are your future goals. If you plan to get for if we continue a previous example, like if you're a millennial and if you've just started your career, you should be planning to arrange for funds for buying some assets like a house or a car, or you should be planning to get married. So these things generally involve higher cost in life, and you should also factor in all these costs while making your investments, so that you don't over invest at the same time under invest. So what happens is, like, if you're planning a 20-year investment horizon and you keep investing all your money in the respective fund, and then suddenly after 5 years you break that investment, then you don't earn a very good return out of it. So you should be well prepared along with a few with all the future plans which you have, and then you should start your investment journey. We will surely come back with more discussions about this segment. And for the time being, if you like the video, you can surely subscribe to our channel and keep investing, stay happy, enjoy your profits. Thank you.